If a corporation is closing now, should this be pursued? The answer is it depends. So because it's a tax credit that's coming from prior year activity, if the corporation is eligible for it, it means they could have been taking it in 2020 and 2021 when it was those payroll returns were originally being filed. So, if your organization is eligible for it, it's not contingent on future activities for you to participate in this program. It's contingent on those past activities, right? So for the most part, the answer is, people tend to want to pursue it, even though the corporation is ending. Now, things you might want to consider with that is, well, if it's going to come back to because the payments come back to the organization's name, if you're not going to have an open bank account under that corporation's name, how are you going to deposit that check? The other issues of, well, who's going to pay for the amended tax returns, and who's going to administer that whole process that needs to happen as well. And then if you have things like, if you're selling the business and there's, contingencies you have to disclose, or, different administrative hairballs that come up, those are things that you'll want to consider. But for the most part, most organizations that I've had in this situation, it made sense for them to go back and still claim it. You just want to consider all the things that it might impact, given especially that if you do a filing now, it's not even going to be processed by the IRS before the end of the year. And so what does that look like for your ability to actually close out the corporation, and why are you closing it out? What's the timing, et cetera?